You watch metals and markets every week, yet still shop with the big guys? Why pay more for your precious metals from the guys who have offices on Wall Street and who bank with JPMorgan? From the basics like eagles, maples, rounds, and bars, to collector coins like Silver Shield and Heroes, SD War Collection, to our exclusive new line of insurance, approved, TL-rated precious metal safes, SD Bullion is what you're looking for. At the lowest prices, period. Guaranteed! Because if you don't hold it, you don't own it. SD Bullion, founded by stackers to help you prepare for what's coming. Shop with the doc today at sdbullion.com.
This is the Doc and Eric Dubin with SD Weekly Metals and Markets Wrap. Well, Eric, as we start our first show here in the new year of 2015, we had a nice pop today in the early afternoon, late morning here, both silver and gold. Silver popping just about 50 cents all the way up to 16. It was pushed back throughout the afternoon COMEX session in the access market, closing right around 15.75, giving up about half of that gain. Gold also had a nice pop today with a vertical move from around 1170, just shy of 1200, and closing the day around 1188. So gold held on to a lot more of its gains today than silver. Definitely a promising start here to 2015, and we saw some pretty decent moves in the mining shares as well today.
Indeed, yeah, and today's trading in gold is really instructive for a lot of different reasons. The initial decline was in the bulk, like the core hours of the London trading, and you can see that there's like a stair-step pattern where stops were being run, and it was probably what we're looking at here is cartel footprints where, you can see them targeting these stops and trying to get the price down lower and then jamming it down. And then right at the COMEX open in New York, you see a little bit of a rise, and yet still the pressure was maintained all the way through until you get closer to the London close and the PM fix, and then all of a sudden we have that huge spike upward. And what that tells people is that most likely what you're seeing there is the impact of somewhere along the lines of the going into the close, interest from some parties looking to try to find physical, and the paper boy is trying to reconcile that part of the London Bullion Exchange, the LBMA. And so, when we talk a lot about how physical ultimately puts a floor into the market, you need to only look at today's trading action to actually see that. It's a perfect textbook example of it. And then, of course, you see the pressure in COMEX and prices going down, and then when we hit the level that basically approximates what the price level was when it closed before the New Year's holiday, it bounced again. And that's interesting because we're moving into a weekend, and typically if there's a lot of concern about remaining exposed to any given asset, this is kind of just a generic rule of thumb in trading, that people would want to lessen their exposure to it, but we see the exact opposite. People are interested in getting exposure to bullion. They're buying that dip, and they're going into the weekend and into the after hours buying both silver and gold, and the shares confirm it. If you look at GDX, you see that we had really, kind of blasé volume throughout most of the day, but then right on the close, even a little bit into the after hours, you get something like 12 million shares transacting, and the GDX closing on its exact high for the day. So we're starting out the year where people are trying to get positioned into the precious metals, and GDX and the mining share space is behaving pretty much as we would have wanted to see it, and how I had talked about it, in the last couple of weeks, where January is probably going to be a really strong year for the mining shares. I mean, we've never seen 4 years back-to-back with mining shares down, and the level of carnage that's happened in the mining shares is such that even just a very small reversion to the mean kind of thesis that could be adopted by even speculators in the normal world or the conventional world of Wall Street would compel a lot of those folks to look at the mining sector space and say, hey, yeah, what the heck, maybe it's worth a little bit of a contrarian dollar here and there to put into the space. So, I mean, those are just minor bright notes, bright lights peering through in the beginning as we start 2015, and it's going to be interesting to see how it unfolds. We also did not see the cartel able to get gold under 1150 or so, 1155. That was the downside target I thought that they could possibly hit and then see a bounce, and they weren't even able to get there. So it goes to show once again that the physical market is forming a backstop and supporting the prices of gold and silver as we go forward.
And it seems to be shaping up, at least in my estimation, for really a serious sustained attack on the $1,200 level next week. We're now about $60 to $70 off of the lows for 2014, but we really haven't seen a big rally yet. We were back above 1,200 for a little while, but I'm looking for, at least in gold, to see a sustained attack next week. And again, the bankers have been capping that level consistently, so really don't expect anything to change there, but it wouldn't surprise me at all to see gold mount another effort to get back above 1,200, and if it does, it could have a nice short-term pop over 1,200 once it clears that resistance.
Yeah, and that also would put it over the 50-day moving average, which would trigger the copycat hedge fund crowd and say, hey, gee, what the heck is going on over here? So, that'll add even more momentum if we do get some momentum. And as it stands, looking at GOFO rates, I don't have Friday's numbers, but going into December 31st, we continue to see a movement back towards the positive. We're still in negative, but it's gone from reaching a negative low of 0.09 back on December 24th to basically a consistent trend of shaving a little bit more towards the positive each day until 0.0425 negative on the 1 month for December 31st. And that speaks to basically a managed retreat pattern where the cartel is realizing that the physical market is constraining them, and they have to reconcile and deal with that problem, and it limits their ability to bomb the heck out of the precious metals, because whenever that happens, it elicits more demand for physical metals. So it's kind of a catch-22. They're stuck, and now we're seeing the managed retreat process, and that also supports the probable higher prices for next week. So that'll definitely be interesting to see. But overall, even if it doesn't really we don't see much momentum on balance during the week. I suspect we will see a couple of spikes and then maybe some choppy trading or whatnot, but at least with respect to the month overall, it's really hard to imagine that, given all of the turmoil that's going around in the world and the consistent high demand for physical, that we won't see much higher prices and a successful leap over 1,200 through January in the very, very least. And looking back saying, well, okay, that was indeed the bottom. People will continue to question it, particularly with this deflation that we're facing now. I mean, it's very clear that the world is mired in a deflationary spiral right now, and it's getting worse. And we see even the economic numbers coming out today are beginning to freak out Wall Street, and the powers that be were not able to start January's trading off in the Dow over 1,800, although they did manage to eke out a tiny little gain for the Dow today to try to save face. I mean, these markets are so managed, it's ridiculous. People, many years gone by, would hear commentary like this and think, oh, come on, they don't manage the markets on a daily basis or even an hourly basis. But I contend that at this point, it is in fact managed at that level. At least a couple times a day you can see unusual patterns that come in and spikes and things like that are happening in the futures markets, which in turn push the stock prices around the indices. So anyway, it's going to be a really interesting year going forward, and this whole deflation question is something that we want to tackle, and that leads us to our next subject. And next week we're going to have a roundtable, and we have confirmed guests that we can tell you about now, and probably some extra guests as well. Bill Murphy is going to come, and David Morgan has confirmed as well. One of the subjects that we're going to debate is this whole endgame sequence, and whether or not you see a deflationary crunch first, leading to central bankers going berserk with the creation of fiat to try to fight it, and then maybe inflation, or whether inflation can come without a huge deflationary burst. I mean, we're in deflation right now. I mean, that just goes without saying. So this whole debate is relevant to how we look at what's going to happen next year, and we invite everybody that's listening to this week's show to come on over to the Silver Doctor's website if you're catching us on iTunes or YouTube or whatever, and feel free to post some questions that you'd like us to consider asking David Morgan and Bill Murphy, and weigh in as well, too, on your perspectives about this whole deflation versus inflation endgame construct and what you think. And we'll incorporate a lot of the comments that people leave into next week's show.
I wanted to give listeners a quick update on the physical market here for gold and silver in the U.S. The U.S. Mint next week begins releasing Gold Eagles for 2015 on the 5th. They're scheduled to release on the 12th. And the first Silver Eagles, and again, those won't yet be available to the public. That's when the authorized purchasers and authorized dealers can place their orders. So Silver Eagles and Gold Eagles will be coming in the next few weeks. We saw quite a bit of demand, even with the kind of thinly traded futures-wise holiday markets over the last couple of weeks. We've seen continued strong retail demand in both gold and silver, but particularly silver, and especially in the days where price has been knocked back down under 16. That 16 level seems to be really a big psychological point right now for investors, that anything below there and buyers are coming out of the woodwork. I wanted to also touch on the big theory that Ted Butler put forth again this week. I know he's been speculating for the last few months that JPMorgan has been the big buyer of Silver Eagles in 2014 as the U.S. Mint set a new sales record. And Eric and I kind of touched on our thoughts about that a couple of months ago, but I thought it'd be interesting to discuss that again, as Ted Butler is coming out this week and claiming that JPMorgan has accumulated perhaps a 300 million ounce stockpile of physical silver. He calls it likely the largest physical silver position in history. And he is speculating that JPMorgan was indeed the big buyer of Silver Eagles, and that his data indicates that JPMorgan bought half of the Silver Eagles the U.S. Mint sold last year, so a little over 20 or 21 million ounces. I've read Ted Butler myself for years and highly respect his work, but as we were discussing before we started recording the show, Eric, I just don't quite see how this is feasible, this claim that JPMorgan is buying Silver Eagles, and for a couple of reasons. Number one, we aren't seeing any evidence of that from any of the authorized purchasers. I speak directly with nearly all of them daily, and JPMorgan is not buying Silver Eagles from them, is my opinion. And also, just the fact that if JPMorgan was wanting to acquire a long physical silver position, that they learned their lesson, so to speak, in 2011 when silver was running away towards $50. It's my belief that they would be taking down good delivery 1,000-ounce COMEX bars. They would not be paying 15% premiums for coins unless they had already soaked up every single other bar form of physical silver on the market, and they're trying to corner every single last ounce of silver. I can guarantee you that JPMorgan really does not care and is not thinking about the end of the world as we know it scenarios and using silver coins as barter and wanting coins versus bar form. So it just would not make sense for them to, in their line of thinking, to be purchasing any silver coin or round or anything that they're paying more than the futures price of a contract of silver on the COMEX.
Yeah, one of the other things he had mentioned as backing up his theory was that he speculated that coin retailers have been seeing lackluster demand for silver. And I don't know where he gets that information. That doesn't seem to mesh with anything that I've come across when it comes to the dealings I've had with other dealers and what we see at ST Bullion certainly doesn't support that. So it's a little bizarre. I mean, to his credit, you know, the logical consistency of the value of having a big hoard of silver as a hedge for JPMorgan vis-a-vis the possibility of, you know, a derivatives crash and all fur flying all over the place and the rest of the financial markets makes sense. I mean, that's a compelling argument. But the rest of the data doesn't support the theory. So
we also haven't seen a real big sudden premium spike that you would see if one big buyer came in and took down some enormous figure like 20 million ounces of Silver Eagles, you would see an immediate premium spike to probably $10 to $12 over spot per coin if that occurred. That one buyer came in and soaked up every single Silver Eagle available in the market, which is what they'd have to do to have those kinds of numbers. And just pure supply-demand fundamentals, it would cause a massive shortage, and the authorized purchasers would begin rationing their supplies, and premiums would spike much higher percentage-wise probably than we saw back in 2008. And we haven't really seen anything like that here with Silver Eagles in 2015.
Yeah, and again, this claim was that the JPMorgan was taking down as much as half of the Silver Eagle supply. You'd see those premiums, half. So these data points don't connect, and it's a little bit odd.
And we have an article, SRS Rocco, our good friend Steve St. Angelo, has been working on posting over the weekend. He kind of also digs into the facts and kind of points out that let's not take all the credit away here from where it really rightfully belongs is retail investors who, in my opinion and in Steve's opinion, that's who has taken down the Silver Eagles in 2014. So make sure to check that out. He did some great work and analysis as well. So that'll be up on Silver Doctors over the weekend as well. Well, before we wrap up the show here, I almost feel like we can't close the show today without discussing the headline of Harry Reid falling off of his own treadmill and breaking bones in his face and ribs after an exercise accident, Eric. I feel terrible, but somehow I don't feel sorry for the man.
If you had a picture of Nancy Pelosi in the front of the treadmill, you kind of lost it. Nancy and him have a long history.
So I wanted to add that in there to a little color to today's show before we close. But again, before we wrap up, just as a reminder for next week, we're excited about the Precious Metals Roundtable with David Morgan, Gatta's Bill Murphy, and hopefully a few other industry experts. So again, on today's or this week's Metals and Markets show over on Silver Doctors in the comments section, if you have any questions for the experts in gold and silver, make sure you leave those. Again, we're planning on focusing our debate on the end game in what the experts believe is likely to happen, but we also like to take some of your questions and discuss their outlook for 2015 for the markets as well. Could we see another further leg down here as the deflationary trend continues with oil?
Yep.
And many oil commentators now are calling for $20 oil, and
probably won't get $20 oil unless we have an economic crash. But the damage that is being caused by currently low prices. In fact, today we hit a brand new low for West Texas Intermediate, 52 and change. Brand new low for this cycle move, that is. I mean, there's got to be dead men walking in a derivative trade as a result of this already, and it just hasn't surfaced all the way through just because we're not at the end of the quarter or not at the end of the month or something like that, which actually is something to think about with respect to early February's trading in the very least. But that is for another show.
All right, so we'll wrap this week's show here. Make sure you tune in next week for the special roundtable discussion with gold and silver experts. So for the Doc and Eric Dubin, thanks for tuning in to this week's SD Weekly Metals and Market.
Those individuals who are in charge of monetary policy around the world, I think they're very much aware of what is coming. When I've asked Federal Reserve Chairman in the committee about this, they never said, no, that's not going to happen. They used the word orderly. As long as it's orderly, it seems to be okay.